Yo, yo. Very good, man. And you?
Doing great, thanks. Just hanging out, checking out, waiting for the meeting minutes here. Should be out now.
Where is it published?
Right here on the website I'm looking at, the Board of the Governors of the Federal Reserve System. They have not been released yet. The most recent press releases are for January, the January meeting.
They're bumping the market right now.
Is that so?
It's everything crazy.
Here's my research. Let's see.
God damn.
This is fun.
This is from January, just so those of you that are just wondering what I'm looking at. But this is the one. This is where they're going to be posting the February 14th emergency Fed meeting minutes. So we'll be seeing that shortly. Take a look and see what the markets are looking like. SPX is down 0.84%. At the moment, SPX and SPY is down about 0.8%. VIX at 26.27. Tesla's at 903. Looking at sundials hanging out at 0.62. The Russell 2000 is down 0.75%. PSLV hanging tight at 815. Sprott Physical Silver Trust. For those of you that don't know, you hear my dogs fighting in the background. Come here, Pen. Come here, girl. Come here. Come here. Come on. Say hi. Come on. All right, good girl. Netflix down at 392. Let's see what we're looking at. Any updates on this? Here we go. This is the one that was released for January 25th and 26th. Okay, this is for the FOMC meeting from January 25th through 26th. The Federal Reserve Board Commission, FOMC on Wednesday, January 25th through 26th. Really, and today they released the attached minutes of the committee meeting held on those dates. We'll see what happened by Jay Powell. Keep an eye on that stuff there. CGME's at 126. AMC's chilling in 1966. Very nice. Looks like a lot of stocks are hanging low. Harley Davidson, after recent great earnings, was up nicely a few days ago and is hanging on for dear life with the rest of them right now. I think everything is going to come down shortly. Let's see what this joint meeting says here. It's a lot of attendees we've got. The agenda for this meeting reported that advices of the election of the following members and also members for a term beginning January 25th were received. Okay. And executive votes. Let's see. This says, by unanimous vote, the committee voted to reaffirm without revision the authorization for domestic open market operations. authorization for foreign currency operations, and foreign currency directive to remove references to the temporary dollar liquidity swap arrangements with foreign central banks. So they're removing the references to dollar liquidity swap arrangements that they have with foreign central banks. Wow. Okay. Let's take a look and get into it and see what this actually says in depth. Make this larger so you guys can probably see a little better, if anybody feels like reading it or looking along. Reaffirmed on January 25th that the Federal Open Market Committee authorizes and directs the Federal Reserve Bank to open market transactions to the extent necessary to carry out domestic policy. To buy or sell in the open market securities that are direct obligations of or fully guaranteed as to principal and interest by the United States in securities. So it's giving them the opportunity to buy more junk bonds and sell more junk bonds and mortgage-backed securities, etc. Hey, come here, dog. Come here. Chill out. That's why she has to go in her crate when I do these streams sometimes. But I'm giving them some freedom. They got to be out. As an outright operation with securities dealers and foreign and international accounts maintained at the selected bank. So the reverse repurchase allows them to continue the reverse repurchase and everything else that they're doing to allow eligible securities in the SOMA to mature without replacement, to exchange in connection with Treasury auction maturing eligible securities in case the eligible securities are the direct obligation of the United States or guaranteed. So they're going to continue to lend and sell all these securities that they can, mortgage-backed securities, etc., collateralized debt obligations and swaps. Scroll over here. Sorry, I want to see what the SPY is at. There we go. Look at that. So this is apparently coming off as bullish news since the market is at 0.4%, which has recovered some of its earlier losses. I don't see it as bullish news other than they're going to continue quantitative easing, which is going to continue inflation, which is going to continue, because of the money printing, it's going to make inflation even worse. But they are supposedly tapering, yet they're still buying $20 billion worth of bonds this month. So, let's see what else we got here. They may reject bids as determined, accept treasuries, securities, or cash as collateral for any loan of securities. Accept agency securities as collateral only for a loan of agency securities. So they can use, there's an aggregate par value of the transactions authorized in paragraph 3 that are the type described in this paragraph shall not exceed $5 billion per calendar year. And that's not changing anything, and $5 billion at any given time. Transactions with consumer accounts, they're able to undertake reverse repo transactions in eligible securities held in the SOMA with the customer accounts for a term of 65 business days or less. And they're also allowed to undertake reverse repurchase and repurchase transactions in eligible securities with foreign accounts. That means the CFTC, not Dodd-Frank Acts, and the SEC are overseeing some of those repurchase agreements happening in holding companies overseas. Stock market and AMC and GME are probably all going to come down before they go back up, my guys. I'm not trying to be pessimistic or be negative here, but we've got to be realistic. If the whole market crashes, before shorts are forced to cover, before the margin call defaults happen, there's got to be margin calls. And that means the stock market's going to come down and bring everything with it. AMC and GameStop are no exception. Until after the margin calls, that is when the buybacks will begin to happen, or immediately before in order to prevent the margin calls. Any Federal Reserve Bank that maintains customer accounts when appropriate and subject to all necessary, so they can use repo and intraday repo transactions consistently. They're not changing any of that. And they're able to continue foreign currency operations. Great. Whoops. Sorry about that. Rim of my hat probably just made a loud noise for you guys. My apologies there. FOMC authorizes the Federal Reserve Bank to execute open market transactions for the system open market account as provided. They can purchase and sell foreign currencies at home and abroad in the open market, including with the U.S. Treasury, with foreign monetary authorities, with the Bank for International Settlements, and other entities. Let's move on. All transactions of foreign currencies undertaken pursuant to this paragraph shall be conducted basically with whatever criminal intentions and abilities the IMF allows them to commit without actually having to stop them or step in. So at prevailing market rates, in consultation as appropriate with foreign monetary authorities, central banks, and international monetary institution, etc. So standalone spot and foreign transactions. Nothing new here. Committee authorizes the subcommittee to direct the selected bank in advance to execute operations for spot and forward transactions. When do they use this? Generally, it's directed at countering disorderly market conditions or undertaken to adjust system balances in light of probable future need for currencies, or for any such purposes as may be determined. So whatever the hell we say goes is pretty much what they're doing. So the committee must direct the selected bank in advance to execute the operation if it would result in the overall volume of standalone spot and forward transactions. So basically it allows them to buy and sell as they please as well, it sounds like, according to this. They use it specifically directed at countering disorderly market conditions of any kind. For purposes of this authorization, the overall volume of these spot forward transactions in foreign currencies is defined as the sum of dollar values sold at the time of the transaction. Not the notional value, the dollar value sold. So that $5 billion worth could be worth 10 or 20 or 30 times that amount. Warehousing. They can conduct swap transactions within the U.S. ESF fund, the Exchange Stabilization Fund, the Plunge Protection Team. Somebody marked this here in the video. How far in are we on here? I'm not sure, but it's 1:14 p.m. The committee authorizes the selected bank with the prior approval of the subcommittee and the request of the United States Treasury to conduct swap transactions with the United States Exchange Stabilization Fund, established by Section 10 of the Gold Reserve Act of 1934. That means the money that's used by the Plunge Protection Team is also used by selected banks authorized by the committee to conduct swap transactions with the ESF. That is one of the ways how they're preventing the current market collapse for as long as they can. Unfortunately, liquidity issues are a big concern for them. The committee authorizes the selected bank to maintain currency arrangements, reciprocal currency arrangements, under the NAFA agreement. Standing dollar liquidity swap arrangement, temporary dollar liquidity swaps, and standing foreign currency swaps, to the extent necessary to carry out any foreign currency directive of the committee. So they must be approved in advance by the committee, but temporary ones only have to be approved by the chair. It's disgusting the amount of things that they're able to get away with. And for standing foreign currency, swap arrangements must be in advance by the committee. Operations involving standing and temporary dollar liquidity swap arrangements and standing foreign currency liquidity swap arrangements shall generally be directed at countering strains in financial markets in the United States or abroad, or reducing the risk that they could emerge, so as to mitigate their effects on the economic and financial conditions. For reciprocal currency arrangements, all arrangements are subject to the committee's review or the chair. It's pretty simple.
Is for emergency.
Yes, it is. That's the old one here. Let me go back. The selected bank may manage such foreign currency holdings by purchasing and selling permitted foreign securities. And those foreign securities are the ones that we are seeing that are taking a beating as well, didn't we? Especially in the most recent executive order changes that were implemented by the United States Treasury, which I can show you guys. But let's swipe through here and finish this first. And then we'll move to the over to these executive orders. So covering the January, let me highlight this for you guys. This is not from the February meeting. This is the minutes from the January 25th and 26th FOMC minute meetings that occurred on Tuesday and Wednesday. I just lost my place on that one, but that's okay because I actually know where we were here. Foreign currency directive. So we left off here. And they have authorized the selected bank to undertake transactions and foreign exchange investments that may be otherwise authorized to for the purposes of testing operational readiness. So this is one way in the way that they conduct, other tests and manipulate our market. It's a better way to put it. Yep, so they're continuing to allow to do all their manipulation here. The Foreign Central Bank of Canada is allowed 2,000 millions. So that's an easy one for those of you guys that are wondering. It's a billion. There you go, 2 billion. And the Bank of Mexico, 3 billion, as you can see. And they are also allowed to conduct standing dollar liquidity swap arrangements with the Bank of Canada, England, Japan, European Central Bank, and Swiss National Bank. As well as, same thing. Same thing for foreign currency liquidity swaps. They have to report it, blah, blah, blah. You know who doesn't have to report it? The plunge protection team. They don't have to report a damn thing. Standing repurchase agreement facility resolution. The FOMC authorizes and directs the open market to conduct, with the SOMA accounts, to conduct operations in which it offers to purchase securities, etc. Same thing we saw above. It allows them to buy U.S. Treasury securities, agency debt securities, mortgage-backed securities. 2008 times 10. Standing FEMA repurchase agreement resolution, same shit. To be conducted at an offering rate equal to the minimum bid rate for the standing repurchase agreement, unless a different offering is available. To be offered on an overnight basis. Nothing has changed here. Subjected per counterparty limit of $60 billion per day. For those of you that are unaware, the RRP limitation is $60 billion per day per member that is participating. Thank you, Irishman. I'll turn down the music. Appreciate you, buddy. Thanks for the heads up. I'm just jamming over here, so my apologies. If it's a little loud, just let me know. Anyways, moving on, the RRP is going to continue. $60 billion per participant cap on the RRP. A formal framework review would commence in 2024 and conclude in 2025. So they have no plans to make any changes at all anytime soon.
Hit the like button when it thumbs.
Drop the thumbs up, please. It doesn't cost you anything. Thank you. Statement on longer run goals and monetary policy strategy. FOMC is firmly committed to fulfilling its statutory mandate from Congress of promoting employment, stable prices, and moderate long-term interest rates. Yeah, okay. Bunch of bullshit. Employment, inflation, and long-term interest rates fluctuate over time in response to economic and financial disturbances. Monetary policy is a role. Yeah, of course. Okay, J. Powell, I could tell your writers wrote this. The committee's primary means of adjusting the stance of monetary policies through changes in the target of the federal funds rate. The committee judges that the level of the federal funds rate consistent with maximum employment over the long run has declined relative to its historical average. Therefore, the federal funds rate is likely to be constrained by its effective lower bound more frequently than in the past, owing in part to the proximity of interest rates to the effective lower bound. That means it's stuck on a lower level right now. The committee judges that downward risks to employment and inflation have increased. So the committee judges that downward risks to people losing their jobs and inflation going higher are better. So there's a better chance that people will lose their jobs, or that we'll have more employment issues, I should say, or be unable to get jobs, and inflation is going to continue to increase. The committee is prepared to use its full range of tools to achieve maximum employment and price stability. Yeah, we've heard that shit before. Do something. Let's see. Do something. What are they going to do? Anything? The maximum level of employment is a broad-based and inclusive goal that is not directly measurable, and that changes over time owing largely to non-monetary factors. Yeah, more like you printed too much fucking money. Consequently, it would not be appropriate to specify a fixed goal for employment. Doesn't matter. Let's move on. The inflation rate over the longer run is primarily determined by monetary policy, and hence the committee has the ability to specify a longer run goal for inflation. They're going to try to keep it at 2%. The committee judges that longer-term inflation expectations are anchored at 2% false report. Yeah, okay, they're trying. I don't see any 2% anywhere other than in your stupid meeting minutes here. It's not 2%. It's at 7.5%, and it's closer to 17 if you use the 1980s calculations. Market is pumping hard on that news. Look at that. It has recovered its losses for the day. The committee's employment and inflation objectives are generally complementary. However, under circumstances in which the committee judges that they're not complementary, it takes into account employment shortfalls and inflation deviations. So what are they going to do? Anything? The manager turned first to a review of domestic financial markets. The S&P 500, Treasury yields rose across the curve, led by higher real yields. Expectations for tighter monetary policy ahead, as well as easing of COVID, were cited as contributing to the increased yields. The S&P 500 index declined around 5%, with sharp moves toward the end of the period. reportedly prompted by concerns about the implications of tighter path monetary policy. Regarding the monetary policy outlook, with data showing continuing tightening of labor market conditions, elevated inflationary pressures, policymaker communications were perceived as pointing to an earlier and faster removal. Let's see if, against this backdrop, respondents to the surveys of primary dealers and market participants almost uniformly projected that the Federal Reserve's net asset purchases would end by mid-March. The median survey projection for the commencement of balance sheet runoff shifted on the third quarter of this year, roughly a year and a half sooner than in December surveys. Most respondents also expected the portfolio to decline at a significantly faster pace. Most respondents expect the portfolio to decline at a significantly faster pace than they did in December. But it doesn't seem that they are going to. Expectations shifted towards earlier rate increases, and interest rate futures priced an increase on the target for the federal funds rate at the FOMC. On average, respondents to the desk surveys assigned a roughly 70% probability to an increase in the target range in March. We know this. All right, I'm going to keep moving on. Moving on, I don't want to read all this crap to you because you don't need to know it that much. I don't believe, but you can pause it or you can go read it for yourself if you like on the FOMC website. Changing views about the likely path of the Federal Reserve's balance sheet following the release of the FOMC minutes seem to affect longer-term yields. That means bonds. That's why they're kind of, let's say, getting closer to inversion. Far forward real yields moved higher over the period, with much of an increase following the release of the minutes for the December FOMC meeting. In addition, agency mortgage-backed securities spreads widened notably after having been stable at low levels for the past year, reportedly driven by expectations for an earlier and faster runoff of agency mortgage-backed securities than expected. The management turned next to a discussion of international financial market developments. Sovereign yields increased across advanced foreign economies, driven by receding concerns about Omicron, elevated inflation, expectations that central banks would remove policy accommodations sooner than had been expected. Several central banks concluded their net asset purchases late last year, and more expected to do so this year. On outlook for policy rates, several central banks had either already increased their policy rates or were expected to do so. Let's see, does this matter to us? Regarding the potential for the committee to reduce SOMA holdings in the future, open market account, for system open market account, market participants generally anticipated that those SOMA redemptions could proceed smoothly at somewhat faster pace than during the previous period of balance sheet reduction from 2017 to 2019. However, some also noted that SOMA redemptions would require significant adjustments to private sector balance sheets as investors absorb the net increase in Treasury and agency mortgage-backed securities issuance to the private sector and money markets transition to lower levels of liquidity, and that these adjustments could take some time. It sounds to me like they're making retail the bag holders. What do you guys think? Take a look at that and tell me, what do you think? That's how it's looking to me. That literally says that SOMA redemptions would require adjustments to private sector balance sheets, retail investors' balances, as investors, again, absorb the net increase in Treasury and agency mortgage-backed securities issuance to the private sector and money markets transition to lower levels of liquidity, and that these adjustments could take some time. Sound like 2008 all over again? Probably because it is, except it's much worse this time. Odd. I was going to bring it to a large screen, but I would rather you guys be able to see this. This here makes it clear that the Federal Reserve knows that SOMA redemptions would require significant adjustments to private sector balance sheets. That means making retail investors the bag holders and pulling out their institutional funds. Do you understand? Federal Reserve and all of these cats know exactly what's going on. The manager discussed expectations for the evolution of the Federal Reserve's administration rates in connection with potential future change in the target range for the federal funds rate. The desk survey responses suggested expectations for administered rates to be raised by the same increment as the target range. That's 0.25, 25 basis points, for those of you that are unaware. I believe. The manager noted that the current setting of administered rates relative to the target range had been working well and anticipated that it could continue to support effective policy implementation. Okay, next. The committee ratified the desk's domestic transactions over the intermeeting period by unanimous vote. No intervention operations occurred in foreign currencies for the system's account. The committee ratified the desk's domestic transactions over the intermeeting period. That's an interesting breakdown right there. They've done that several times. Check this out. They did that in December 15th, 2021, March 17th, 2021, July 7th, 2021, February 17th, 2021, February 18th, 2015. Fed officials 4/9/2014, April 9th, 2014. Fed officials try to walk back rate hike forecasts in FOMC minutes. It's a fucking replay. This is Groundhog's Day. 2008 is here again. This is, again, the minutes of the FOMC committee's meeting from March 18th, 19th of 2014 have just been released. They said the same things that they were saying now, pretty much. And the S&P has advanced to its high of the day on the news, and treasuries have turned positive as well. Old fucking Yeller was top of the heap then and continues to play this fucking game. Right along with her fucking best friend, J-Pow. Get the goddamn money printer out. This is nothing you haven't seen before. They're trying to walk back the rate hikes, trying to make it seem like it's not so bad. Like it's not so bad. Take a look. So yeah, we're gonna have a nice pump on the stock market here. It looks like we're up 0.18% on the day, 0.14, whatever you want to call it, on the SPX. Let's check out the Nasdaq's down 0.77% still. So that doesn't bode well for the Nasdaq. The Nasdaq 100 is down 0.86%. The NDXT, the technology index, is down 1.62%. Does that look like a bullish stock market to you? HSBC Holdings is down. Goldman Sachs is down. Google is up 0.5 percentage point. They're good collateral, so it makes sense that they would get pumped. Facebook's down 2.5%. Meanwhile, penny stocks lead the everything right now. It's all about penny stocks. Check out the top gainers. All penny junk stocks. Easy collateral. Look at the value of these things. All the runners for today. Pink sheet, bullshit. Pink sheet, bullshit. I wouldn't be surprised if Evergrande is up here. Let's see what we got. Singularity Future Technologies. Got Ouster Inc. Hermes PLC. Just a bunch of pink sheet crap. Principles for reducing the size of the balance sheet. Participant, back to this meeting minutes, for the meeting minutes that were released today for January 25th FOMC meeting. Pop this back up in here. Take a look. AMC's hanging out at 20 bucks. 20 bucks, hanging strong. I like that. So we got DoorDash is down 6% at 95. GameStop's at 128.59, up almost 2% today. That's great. Peloton's down 2.8%. The QQQ is down 0.2% to 355.40. The Russell 2000's up 0.3%, probably on heavily shorted stocks getting repurchased or, FTDs being bought back and rolled over. The SPX has just lost its gains. And the VIX is down currently 4.7%. So the principles for reducing the size of the balance sheet. Participants continued the discussion of topics regarding the policy tools that may be appropriate. All right, let's see what they actually said of any actual value here. Participants discussed high-level principles that could be released to the public to describe the committee's approach. At a high level, the sequence of adjustment to the interest rate and balance sheet tools to reduce policy accommodation, whatever. Their discussion was preceded by staff presentation. This is bullshit. Participants reaffirmed the changes in the target range for the federal funds rate are the committee's primary means for adjusting the stance of monetary policy. So they're going to continue to taper slowly, meanwhile raising rates. It makes no sense to raise rates while not while not stopping quantitative easing entirely. It makes no fucking sense. Market conditions would have to be monitored closely to determine the appropriate longer run level of reserves and the size of the balance sheet. Participants agreed that the committee should reduce the Federal Reserve securities holdings over time in a predictable manner, primarily by adjusting the amounts reinvested of principal payments received from securities held in these SOMA, Security Open Market arrangements. We hypothecated bullshit of your pensions and 401ks, IRAs, and ISAs account. Participants agreed it was appropriate for the committee to publish its high-level principles for reducing the size of the Federal Reserve balance sheet. Okay, let's get on with it, you fuckers. Here are the principles for reducing the size of the Federal Reserve balance sheet, effective January 25th, 2022. Yeah, this is going to be fucking hilarious. Let me spark a blunt so I can see this nonsense. The FOMC agreed that it's appropriate at this time to provide information. All participants agreed on the following elements. The committee viewed changes in the target range for the federal funds rate as a primary means for adjusting the policy. They'll determine the timing and pace of reducing the size of the FOMC balance sheet to promote maximum employment and price stability. The committee expects the reducing of the size of the Federal Reserve balance sheet will commence after the process of increasing the target range for the federal funds rate. So reducing the size of the balance sheet will not happen. They will not stop quantitative easing until after they've raised interest rates. The committee intends to reduce the Federal Reserve securities holdings over time in a predictable manner by adjusting the amounts reinvested received from securities held in the SOMA market. The committee intends to maintain securities holdings an amount needed to implement monetary policy and effectively in its ample reserve regime. In the longer run, the committee intends to hold Treasury securities in the SOMA, minimizing the effect of the Federal Reserve holdings on the allocation of credit sectors. Unfucking real. The committee is prepared to adjust any of the details of its approach to reducing the size of its balance sheet in light of economic and financial developments. So the information available at the time of the January 25th, 26th FOMC meeting suggested that the U.S. real GDP had picked up in the fourth quarter after slowing in the third quarter. Labor market conditions improved further in December, and indicators of labor compensation continued to show robust increases. CPI throughout November, as measured by the 12-month PCE, remained elevated. So GDP growth means spending the money. Labor market conditions improved further. However, 4 million people quit their jobs in November and December each month. Well, actually, from April all the way through December, 4 million people per month were quitting their jobs because of vaccine mandates and other jab restrictions, you name it, and just inflation and knowing their worth. Non-farm payroll employment posted a moderate gain in December. The unemployment rate declined from 4.2% in November to 3.9% in December. The one thing they don't note is that anybody who hasn't looked for a job in the last 4 weeks, either because they're sick or because they haven't actively been looking, if they've been unemployed for over 4 weeks, they are not counted as unemployed. They are counted as out of the workforce. That allows them to reduce the number of unemployed people. So anybody who's been out of a job for 5 weeks and hasn't been to a job interview in the last 4 weeks, according to their survey, is not unemployed. They are out of the workforce. That is nonsense. That's cooking the books on these numbers to feed us bullshit. Labor force participation rate was unchanged in December, and the unemployment to population ratio moved up. The employment to population ratio moved up. The private sector job openings rate, as measured by the job openings and labor turnover survey, moved down in November, but remained well above pre-pandemic levels. The quits rate was also elevated. Notice how this is just so eloquently and shortly stated. The quits rate was also elevated. 4 million people per month quitting their fucking jobs. The private sector job openings moved down in November. Okay, look at the way that they're fucking wording things. Labor force participation was unchanged. More people did not join the labor force, but they are unemployed people. They were able to decline it from 4.2 to 3.9 because if you've been sick because of COVID or whatever, you haven't actively been able to find a job or look for work in the last 4 weeks, you are not counted as unemployed. Plain and fucking simple. Weekly estimates of private sector payrolls constructed by their staff using ADP information for the first half of January pointed to a slower pace of private employment gains relative to December. So all of the actual data points to this not looking so hot. Average hourly earnings rose at an annual rate of 6.2% over the last 3 months of the year. However, inflation is way higher than that. Although wage increases were widespread across industry, they were particularly notable in the leisure and hospitality sector, as well as transportation and warehousing. Inflation readings remained high, and various indicators suggested that inflation pressures had broadened over the second half. That means there's more issues. There's going to be more inflation. That's what broadened over the second half of 2021 meant. Total PCE price inflation was 5.7% over the 12 months ending in November, and core PCE price inflation, which excludes changes in blah, 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 was 4.7%. Bunch of bullshit. The trimmed mean measure of the 12-month PCE inflation constructed by the Federal Reserve Bank of Dallas was 2.8%. More bullshit. In December, the 12-month change in consumer price index was 7%, while core CPI was 5.5 over the same. So 7.0 in December, 7.5 in January, as we now know, and it's going to continue to rise or stay elevated for a long time before it goes down, thus devaluing your dollar even more every single day. Sadly, I'm sorry to say. The staff's common inflation expectations index, which combines information from many indicators, had largely leveled off over the fall. It was close to its 2014 average. Nonsense. Real PCE was unchanged in November. It's already ridiculously high. Producer PCE was unchanged in November, and available indicators, including the components of nominal retail sales data used to estimate PCE, pointed to a decline in December, possibly reflecting the sharp rise in COVID-19. Housing demand remained strong, and available indicators suggested that residential investment increased in the fourth quarter, but they didn't say by who, because the majority of that is institutional buying. However, shortages of construction materials, buildable lots, and other inputs continued to weigh on activity in this sector. Business fixed investment appeared to post only a small gain in the fourth quarter, as investment in transportation equipment was held back by supply bottlenecks and limited supplies of construction materials restrained non-residential structures investment. It also could be that there aren't that many companies and corporations looking to expand right now. I think that's a little bit more likely. Manufacturing output moved downwards in December after advancing strongly in October and November. Motor vehicle assemblies reversed some of their November increase. In addition, manufacturing production outside of motor vehicles ticked lower. Basically, manufacturing all around the country is not as strong as it was in October and November. Total real government purchases appear to have fallen in the fourth quarter, although available data suggested that real federal purchases rose. Well, look at that. So basically they're saying they're not spending more money, but they're spending more money, thus continuing our inflationary problems. Indicators of real estate and local government purchases pointed to a decline in the fourth quarter despite state and local governments' extremely strong budget positions and the widespread return to in-person schooling last fall. The trade deficit widened at the end of last year. Imports of goods rose sharply in November and December, led by increases in consumer goods, while exports of goods were little changed over the 2 months on that after surging in October. What this means is that imports are required more than exports for us right now. We're not producing as much and exporting as many goods, even though, as far as the percentage of change goes, not the actual amounts. We do export a lot of goods, don't get me wrong. But this is due to a lot of things, among shipping congestion, as well as COVID issues, but it's got a lot to do with outside macroeconomic and geopolitical factors, including some unconstitutional vaccine mandates all across the world at this point. Meanwhile, service exports jumped in November. Service exports, reflecting a sizable increase in exports of travel services after the reopening of U.S. borders to vaccinated foreign travelers. Even so, service trade was very low relative to pre-pandemic norms, largely because the level of international travel is depressed. Foreign economic growth picked up in the fourth quarter of 2021. And for those of you that don't know, places like China continue to print money at an astronomical pace. Back to it though. As economies in emerging Asia bounce back from lockdowns in the third quarter, induced by the Delta variant, purchasing managers indexes, PMI, pointed to improved supplier delivery times and foreign vehicle production rose notably, suggesting that these supply bottlenecks continued to ease. However, the rapid spread of Omicron variant led to renewed public health restrictions in several countries, particularly in China, which appear to be weighing on activity at the start of the year. What's going on, guys? Why do you say I need a tech? Am I jamming my music too loud again? Because I play it for me, not for you. Sorry if it's annoying. There you go. 1K? Who said that? Who said that? 5-figure minimum. I'm holding some for 6 figures. What the fuck else do we have? I need to know. I gotta plan ahead for my businesses here. I need to know what the fuck's coming. Inflation abroad continued to rise, mostly driven further by these rise in retail energy prices, effects from supply bottlenecks, and some emerging market economies by rising food prices. Inflation. Can you say Turkey, Venezuela? That said, input and output price components of PMI's producer management index is provides some tentative signs that easing supply constraints have started to contribute to some let-up in inflationary pressures in several foreign economies, but highly doubtful that one of those is ours. The expected path for the federal funds rate over the next few years, implied by a straight read of overnight index swap quotes, rose notably since the December meeting, apparently reflecting less accommodative than expected FOMC communications. Wow. That's bearish, or hawkish, whatever you want to call it, and an easing of concerns around the economic effects. Those factors also contributed to notable rises in 2, 5, and 10-year nominal treasury yields. Inflation compensation implied by Treasury inflation protected securities rose slightly on that. We are seeing an inversion of the yield curve slowly but surely. Broad equity indexes decreased markedly. Look at that. Broad equity indexes decreased markedly on net, particularly in the latter part of the meeting, as shifts in expectations about the pace of monetary policy tightening, global inflationary pressures, and escalating tensions between Russia and Ukraine weighed on equity prices. The 1 month implied volatility on the S&P 500, the VIX, increased considerably on net to above the 90th percentile of its historical distribution. Spreads of investment and speculative grade corporation bonds widened modestly. Spreads of municipal bonds were roughly unchanged. Short-term funding markets were stable over the intermediate period. According to them, I saw January 26th, the plunge protection team had to come in and spend $10 to $50 billion to buy back a 13% plunge on the SPY. We saw that in the form of put selling in order to cause a gamma ramp on the SPY through futures buyers and sellers. Short-term funding markets were stable. Sorry, bullshit. The effective federal funds rate and secured overnight financing rate generally held steady at 8 basis points and 5 basis points. Participation in RRP, reverse repurchase program operations, averaged $1.6 trillion, about $150 billion higher than during the previous intermeeting period, and reached an all-time high of $1.9 trillion at year-end of 2021. Government money market funds continued to receive investment inflows and accounted for the majority of on-RRP take-up. Government money market continued to receive investments and accounted for the majority of RRP, reverse repurchase program. The Fed is saving these banks every single day. They're saving each other. Movements in foreign asset prices responded to waning concerns about the Omicron's political variant. All right, let's see what else we got, if anything. Geopolitical tensions, AFE sovereign yields increased notably, EME sovereign spreads widened, capital flows dedicated remained slightly negative, while flows into those funds turned positive. That doesn't sound bullish at all to me. Financing conditions for non-financial firms remained broadly accommodative. All right, that's good. Commercial and industrial loans expanded over the fourth quarter, following more than a year of declines. It's not bad. The credit quality of large non-financial corporations remains strong. I would beg to differ on that one, but we'll save that for another live stream because you guys have probably already seen all the videos that I've done showing that we have $426 trillion in total assets, derivatives notional value, amongst the world top banks right now. $426 trillion. Yes, I said that. But they've only got a few trillion in actual assets to hold that collateral. Financing conditions in the municipal bond market remained accommodative as municipal bond yields stayed near historic lows. Not quite. Let's take a look at the U.S. 10-year versus 2-year and see what we're looking at. Let me go back to the others. That looked better for you guys there. Let's sneak this in here a little bit wider. It's pretty rough. This here, the lower this is, this at its lows, this is an inversion of the yield curve. Every time that this comes down, it is inverting the 10-year Treasury yield minus the 2-year Treasury yield. And every time this comes down here, this is a negative yield, this is an inverted yield curve, which triggers and signals a recession every single time. Every single time. We saw it in 1989. See, here we go. We saw it in 1989. We saw it in 2000. We saw it in 2007, 2006 through 2008. And we saw it in 2020. Moving in a little bit closer here. This was when the federal government started printing. The federal government had to step in to save the reverse repurchase, the banks in the reverse repurchase program on September 19th, 2019, because the yield rate went all the way up to 10% for the overnight repurchase. Therefore, they had to begin quantitative easing. And in doing so, by beginning quantitative easing, they started printing money and controlling the RRP. And then in February of 2020, the government announced that it would be spending tons and tons of money in quantitative easing in order to prop these banks up because of COVID. And that was the idea here. So that brought us further away. That reduced the inversion of said yield curve. And now it's reduced it even further to the point where that yield curve is going to be inverting again soon. Commercial real estate loan balances on banks' books expanded at a solid pace in the fourth quarter. Banks reported an easing of standards on such loans amid stronger demand for certain commercial real estate loan categories. That's great. In the residential mortgage market, financing conditions remained accommodative, particularly for borrowers who met standard conforming loan criteria. Standard loans, 20% down payments. In the January SLOOS, banks reported easing lending standards for most mortgage categories in the fourth quarter. Mortgage rates increased over the intervening period in line with rates on agency mortgage-backed securities and 10-year Treasury securities, but remained low. Thank you, Jared. Appreciate you guys. If you have any questions, let me know. I'll take a couple of questions here, but we're wrapping up here towards the end of this thing. Financing conditions for consumer credit remained accommodative. None of that really meant, that's good, but it doesn't really mean much. The staff provided an update on its assessment of the stability of the financial system. The staff judged that asset valuation pressures remain elevated. They're literally telling us that asset valuations are too high. Forward price to earnings ratio for the S&P 500 stood at the upper end of its historical distribution. High yield corporate bond spreads and the excess loan premium for leveraged loans remained at low levels, and house prices grew strongly with price to rent ratios that were at elevated levels. This is not good. If you read this and you think this is bullish, you're a dumbass. I'm sorry. Unless you're an investor that owns tons and tons of real estate and rents it out for a lot of money and makes money off it, this is not good news for your home prices, for your rent prices either. The staff noted that market cap of crypto assets had grown significantly over the past decade and experienced considerable volatility, including sizable declines since late last year. They changed its investment of vulnerabilities associated with non-financial leverage from notable to moderate. So they have changed assessment to moderate from notable, noticing that the measures of business leverage had declined to pre-pandemic levels. Household delinquency rates remained relatively low, while household borrowing rose. Vulnerabilities arising from financial leverage remained moderate. Risk-based capital ratios for banks remained above their pre-pandemic levels even after the resumption of shareholder payouts. Some available measures of hedge fund leverage continued to increase, and important data gaps continue to limit a full assessment of vulnerabilities posed by many non-financial bank institutions. Read that clearly. Vulnerabilities arising from financial leverage remained moderate. Risk-based capital ratios for banks remained above their pre-pandemic levels. In contrast, some available measures of hedge fund leverage continued to increase, and important data gaps continued to limit a full assessment of vulnerabilities posed by these hedge funds and these non-bank financial institutions, family offices. Vulnerabilities associated with funding risks were characterized as moderate. Prime and tax-exempt money funds continue to have structural vulnerabilities that may lead investors to withdraw funds quickly in a stressed situation and were a potential source of spillovers to short-term funding markets. This means a run on the banks is highly likely, and they are subject to structural vulnerabilities that may lead to investors to withdraw funds quickly in a stress situation, leading to spillovers to other short-term funding markets. Overly shorted stocks. Do you understand how this equals AMC and GameStop? Because if not, you're not understanding the big picture. This is much more than just an AMC or GameStop thing. It's about every heavily shorted stock and ETF on the entire stock market globally. The Brazilian depository receipts, the German depository receipts, all the ETFs and the synthetics held all around the world. It's going to be absolute madness. There's going to be a massive fucking run on the banks, just like the Canadians were talking about due to the convoy, having its money taken from GoFundMe, and having Trudeau state that they could label them as terrorists and take away their national freedoms. In response, the SEC proposed reforms in December to make these funds more resilient. Another vulnerability in funding markets was significant growth in stablecoin arrangements over the past few years, which may increase challenges related to run risk and pose additional risk from their potential role as a means of payment. So whichever way you look at it, they increase challenges related to risk, to runs on stablecoins, crypto, the stock market, banks, you name it, is the players. The near-term projection for the U.S. economic activity prepared by the staff for the January FOMC meeting was weaker than in December, reflecting the sharp rise in COVID-19 infections caused by the rapid spread of Omicron and an assessment that supply constraints would resolve more slowly than expected. Although real GDP still appeared to have a postable sizable gain, output growth was expected to slow noticeably in the first quarter of 2022 before picking up again later in the year. You know what? I'm going to stop right there and take a quick screenshot because this right here is the meat and potatoes of this entire thing. This is disgusting. I need to get a screenshot of this and I'm going to post it on Twitter because people need to see this as well. The staff judged that asset valuation pressures remained elevated. That's not surprising at all. They characterized the financial vulnerabilities on the U.S. financial system as notable. Asset valuation pressures remained elevated. Insane. Hedgies are fucked. Hedgies are fucked. Household delinquency rates remained relatively low while household borrowing rose. Vulnerabilities arising from financial leverage remained moderate. Vulnerabilities associated with funding risks were characterized as moderate. Hedge fund leverage continued to increase. The staff's near-term projection for PCE price inflation was revised up relative to December in response to anticipated slower response to supply chain issues. PCE price inflation was projected to decline to 2% in 2023 before edging up to 2.1 in 2024. Do you really think that's going to happen? They also said inflation was transitory. The Fed is way behind the curve. The staff continued to judge that the risks to the baseline projection for economic activity were skewed to the downside. Of course, baseline projection for economic activity are skewed to the downside, and that the risks to the inflation projected are skewed to the upside. They're telling you the economy's going down and the inflation's going up. Read between the lines. In particular, the possibility that the economic effects of the virus would turn out to be larger. Hang on, let me scroll back. Where the hell we ended up. The possibility that the economic effects of the virus would turn out to be larger than assumed was viewed as an important source of downside risk to activity, while the possibility of more severe was viewed as an additional downside risk and an upside risk to inflation. Looks pretty negative either way. They did note that indicators of economic activity and employment continued to strengthen, but those are only indicators. Remember, they did not count the people that have been out of job for more than 4 weeks but haven't looked in the last month. Pretty easy stuff. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to the elevated level of inflation. Overall, financial conditions have remained accommodative. Yeah, we keep hearing that over and over again. Risks to the economic outlook remained, including from new variants of the virus. Okay, we've seen this. All right, we know this. Participants noted that supply chain and labor shortages continue to limit business ability to meet strong demand, with these challenges exacerbated by the emergence and the spread of Omicron variant. In particular, the wave had led to a much more widespread worker absence due to illness, virus exposure, or caregiving needs, which curtailed activity in many sectors: airlines, trucking and warehousing, etc. Some participants reported that their business contacts were hopeful that the effects of Omicron would be relatively short-lived. Nevertheless, several reported their contacts expected supply chain issues to persist. Yes, as the owner of a supply chain company, I can tell you that I don't suspect that supply chain issues will be much better in the next 3 to 4 years. Yes, years. They noted that the labor market made remarkable progress in recovering from the recession, but that's not really saying much when most people were forced to either quit their jobs or were fired or lost their jobs because of places closing and vaccine mandates. Labor demand remained historically strong, and that labor supply remained constrained. The maximum level of employment consistent with price stability evolves over time. Participants expressed a range of views regarding their assessments of current labor market conditions relative to their goals of maximum employment. Many participants commented they viewed labor market conditions as already at very close to consistent with maximum employment, citing indications of strong labor markets, including the low levels of unemployment rates, elevated wage pressures, near record levels of job openings and quits, and a broad shortage of workers across many parts of the economy. A couple of participants commented that, in their view, the economy likely had not yet reached maximum employment, noting that even for prime age workers, labor force participation rates were still lower than those that prevailed before the pandemic. The Biden administration, I don't care which, I would say whichever administration is in the place right now, the Biden administration has created a problem through printing too much money. Instead of tapering immediately and allowing a recession, they overly printed, caused too much inflation, and now we're going to have a harder recession than we would have. Unfortunately, The unemployment numbers are being skewed, and labor force participation rates are still lower than those that were prevailed before the pandemic, or that a reallocation of labor across sectors could lead to higher levels of employment over time, but hasn't yet. Participants remarked that recent inflation readings that had continued to significantly exceed the committee's long-run goal were persisting longer than they had anticipating, reflecting supply and demand imbalances related to the pandemic and the reopening of the economy. However, some commented that the elevated inflation had broadened beyond sectors most directly. That means that people are noticing it all over in all sectors, not just in energy and autos anymore. It's in everything. Inflation is affecting every single thing we touch, use, see, hear, smell, and taste every single day. Various participants cited other developments that had potential to place additional upward pressure on inflation, including real wage growth in excess of productivity growth and increases in prices for housing services. This is not bullish. This is not bullish. This is very bearish, unfortunately. There was a burden on U.S. households, particularly those who were least able to pay higher prices for essential goods and services. Some participants reported that their business contacts remained concerned about persistently high inflation. They were adjusting their business practices to cope with higher input costs by raising prices and utilizing contracts that were contingent on their costs. They expected inflation to moderate over the course of the year as supply and demand imbalances ease. Some participants remarked the long-term measures of inflation expectations appeared to remain well anchored, which would support a return of inflation. Highly, highly doubtful. I hate to tell you. The committee is going to keep the target range for the federal funds rate at 0 to 1/4% in support of the committee's objectives of a maximum employment. They are not going to fight inflation. They're not going to raise rates enough.
Muted on YouTube.
boss, you're muted, mate.
Off or something like that.
You're muted.
Well, that sucks. Still muted?
He muted Discord as well.
Yeah, they shorted my audio. What the fuck's going on? My audio's been wrecked.
Here.
That sucks. Oh, in the Discord? Well, if I'm muted in the Discord, my apologies. Anyways, wish you all peace and wealth. That's the conclusion of the meeting minutes for January 25th, 2016. If you didn't feel like reading it, you can watch this video and get all the information from it for the most part. That's the meeting minutes that were released today, February 16th, 2022, from the FOMC meeting on January 25th, 26th, 2022. It was pretty hawkish, in my opinion, and we don't have the minutes for the meeting, the emergency meeting that occurred on February 14th, Monday of 2022 yet. So that being the case, we'll see what happens next. I don't particularly see this being as a bullish statement or bullish meeting minutes in any way. So for the market to be pumping on the news of this meeting, I find that to be hard to believe, because this was garbage. And this inversion of the yield curve that we're going to see again, just like we saw in 2020 and many times before, every time we had a recession, it's unfortunately going to be hitting us very shortly. So on that note, enjoy the pump while you can. Happy trading. Peace out.